2014. 2014 is when Toyota announced that they were going to be moving to Dallas-Fort Worth from Torrance, California. And at the time, I knew that it was going to be a big deal, but I really didn't understand how much it was going to impact a market, because they announced that they were going to go to Plano, Texas, and they moved there in 2016. And at that point in time, literally, we were still grazing cows and horses on most of the land that's out there. And if you drive out there now, it is as urban as you can get with 20, 30-story buildings and shopping malls and restaurants and density, multifamily living, etc. This is before the Cowboys moved their practice facility out there and all the office space out there. I mean, literally, there just wasn't a whole lot out there. And Toyota built a city.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Grant Pruitt. Grant is the co-founder and president and managing director of White Box Real Estate, LLC. Grant launched the firm as a tenant-focused real estate advisory, investment, sales, and development firm to specialize in offering a custom-tailored approach. And in just a minute, we're going to speak with Grant about the commercial industrial real estate of the market in Dallas, Fort Worth, Texas. And before we get started, quick reminder, if you like CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Grant Pruitt. Welcome to CREPN Radio.
Thank you for having me.
Well, Grant, I am delighted you're here and looking so forward to our conversation. Before we get started, if you could take just a minute and share with the listeners a little bit about your background.
So I was born to do real estate. I am fortunate from a background standpoint to have grown up in this business. My parents are both real estate brokers. I started in this business when I was in high school, knocking on doors, cold calling warehouses on the east side of San Antonio. And I loved it. I thought it was fun. I certainly didn't want to do it as a living. I wanted to be a doctor as a kid because it seemed like they played a lot of golf and made more money than anybody else. So I did that when I was in high school. When I went to Southern Methodist University, which just got into the ACC. Excited about that. And be a lot better games to watch than when I was there. But I went to SMU. They had a program called the BBA Scholars Program, and they took 100 kids from the incoming freshman class, and they automatically accepted them in the business school. The only way I got into this program was because my resume was stuck to the back of somebody else's resume. There was absolutely no reason that they ever would have let me into this program. And it was a once in a lifetime opportunity, I knew. and I took it. I was actually pre-med when I went to SMU because I still didn't want to be in real estate. I thought that real estate would be a good side job for me while I was going to school. So I started looking for opportunities to work at commercial real estate firms just because of that. And I couldn't get anybody to hire me. Simultaneously, through this program, I had the opportunity to take business courses because, they talk about majoring in business and studying business. And I remember as a kid, what is business? I had absolutely no idea what business was, and how do you major in something that you don't know what it is? So, suffice it to say, I had a really good time my freshman year, and I needed to take some easier courses to get my GPA up so that I didn't lose my scholarship. And I was pretty good at real estate, and I wasn't half bad at Spanish either. And so that, from a educational background, got me into it. And at the same time, I kept looking for somebody to hire me. Nobody would hire me. So I went back home, and my father said, you know what? You learned how to do warehouses last summer. Why don't we do office buildings this summer? So I started working and helping him with office buildings the next summer. And I got lucky. I went back to school, and that fall, Stream Realty hired me. And I got a job working as an intern doing downtown office leasing. And it was awesome. That was the break that I needed. I loved it, and I thought it was just unbelievable. I got to office in a 50-story office building, and growing up in the San Antonio area, the tallest building was a 36-story hotel. So I thought it was unbelievable. And as I went through school, I did really well in real estate, and I really enjoyed working as a commercial real estate professional. So when I went to get out of school, I had been seeing all these tenant representative brokers or real estate professionals, tenant advisors that were coming into town, touring these listings that I had. And they seemed to be having way more fun than I was. They were making more money than I was. And they seemed to enjoy it a lot more than I was enjoying what I was doing. Because, the tough thing about being on the leasing side is you can show a space 100 different times, but nobody leases it because you really don't have any control over that. And they always teach you, after the listing, when they tell you that they didn't select your building, well, what could we have done different? And the answer typically was, well, if you tore the building down, moved it to another location, had a completely different design, configuration, different space, and built it somewhere else, then we would have leased it. Other than that, you had no chance of ever leasing this. And I had a couple spaces that had this cutback in them with a column there, and so it was really inefficient. And I knew that. And I said, you know what? I'm gonna try representing tenants. And I'd like to say the rest of his was history, but it wasn't. So I started, when I first got out of SMU, I started working on the tenant side at Stream Realty. And I say oftentimes, and it was a wonderful experience. Stream had just turned 10 years old. I think they're 25 years old or something like that now. They had their headquarters in Dallas. They had just opened Houston, and they had an office in San Antonio. And now they're all over the place. They've gone from, what was a boutique at the time to being a really a large national force. And I was fortunate in a couple of ways in that, I got the exposure to the founders of Stream, Mike McVean and Lee Bellin. I mean, they were there day in and day out every single day. I used to go to lunch with them. They probably don't even remember going to lunch with me, but it was very impactful for me at the time. But what I found was real estate companies, when they're boutiques, typically have a bent, and they had a leasing bent, and I was focused on the tenant rep side. So it really was a difficult place to do tenant representation. And I had a cousin that was working at Cushman & Wakefield, and he knew that I was struggling. I mean, I was really struggling, and he knew that I was looking for a good mentor in the tenant rep side. And he called me and he said, hey, there's a guy that works here at Cushman. He's the junior that worked for him went to go work for some startup that nobody's ever heard of called Salesforce out in California. Probably a terrible move. And if he's listening to this, I think it worked out okay for him. He's done very well working for Salesforce, but it opened the door for me to go work for Mike White and Bill McClung, and they were fabulous mentors for me. I had a junior broker that was kind of a co-partner, if you will, and that really launched my real estate career, was working with them and for them. And at that point in time, Cushman and Wakefield in the state of Texas didn't lease buildings. This was before the Cousins acquisition. This was before the DTZ merger. And it was a tenant rep only firm. And that's what I did. That's what I specialized in. I absolutely loved it. You know, the industry started to change. The company started going public. Cushman was acquired by TPG, Texas Pacific Group, that also acquired a company called DTZ. They were going to merge them, take them public. They ended up doing that. And I really saw a change in the industry. I saw a shift from what I used to do, working with tenants, buyers, users of office and warehouse space, to focusing more on facilities management and what they considered sustainable recurring revenues that Wall Street was demanding. And I got really lucky because I was frustrated. I knew that the business was changing. I knew that the industry was changing. And I had a really good friend and client. And my intent was to call a couple of clients that I was really close with and tell them that I wasn't sure what I was doing. I was looking for some advice. He travels a lot, and he happened to be in town, and I happened to have done his office lease directly across the street from where our offices were. So I called him up and I said, "Hey, I wanted to see if you're around in the next couple of weeks. I'd come by your office." It's like, "Well, I happen to be in town today, and I have an hour that's available." So, I call it a godsend, call it whatever. It was amazing. So I go over to his offices and I said, "Hey, look, this is what's happening. There's a change in the industry. I'm not sure really what to do. I could change the jersey, but it'd still be playing the same game and wouldn't be any different." And he said, "Well, have you ever thought of starting your own real estate firm?" I said, "Well, I thought of that, but I'm a good young real estate broker, a good young salesperson, anybody that's in sales, and I don't have enough money saved up to be able to launch a real estate business." And he said, "Well, tell you what, I want you to go home, think about what it means to own and operate a business. If that's something that you want to do, I want you to put together a business plan for me. And I'll be back in 2 weeks. If I like it, I'll back your business. If I don't, or if this is something that you don't want to do, no harm, no foul, we'll part ways." And that's how Whitebox got started. I had the lucky golden ticket. And I haven't looked back. That was 7.5 years ago, and here I am today. And as a company, we focus on tenant, buyer, user representation of office and warehouse space. We have a group that does investment sales, specifically in the RV and self-storage units space. We're growing that one as well. We have an office, our headquarters here in Dallas. We have an office in Houston. We have an office in Fort Worth. We have an office in DC, and we have a little satellite in Austin, Texas. And we're continuing to grow. We're continuing to grow our head count. We're continuing to expand the business. And we've been fortunate to do about, in the last 7 years, $1.5 billion worth of real estate transactions. I'd like to be able to tell you how many 100 million square feet worth of space that is, but I'm not really sure what that is. And I know in 1 year we did deals in 44 states, 6 countries, 3 continents. At this point in time, I think you'd be hard pressed to find a state we haven't done work in. And I know we haven't done work in Antarctica, but that may be the only continent that we haven't done work in. And so, we're full service on the tenant side. I say we're like a visa. Anywhere they want to be, that's where we are. That's where we've done work. And we work with groups that are small. We work with very large publicly traded corporations and everything in between.
Wow, that's an exciting kind of a story there from your start in high school. And you mentioned both of your parents were in real estate. Were they both commercial, or was one residential, or?
Yeah, all commercial. So my mother was in residential lending, or excuse me, commercial lending, not residential. Commercial lending in the 1980s. My father was working for a developer in the 1980s. Neither one of them was doing that by the time the 92, 93, 94 rolled around. Because if you're familiar with the real estate cycles, especially in Texas, just about every bank except for Frost Bank failed in this state, including the bank that my mother worked for. All the developers, or most of the developers, went out of business, and a lot of people ended up going into the tenant rep space. And so actually both my parents are tenant rep brokers at this point in time.
Well, that's definitely in the family. And it sounds like you said your cousin was also,
I
is
have,
also.
yeah, I have a cousin that does multifamily. My brother is a leasing agent in Houston. I have two uncles that are in commercial real estate. And I do get people all the time that say, well, how long are you going to do this? And how long is your family going to do this? And that's what's great about the business that I'm in, is it's kind of like being an attorney. You can dial back the hours, but you're always of counsel. That's what I do is that you may not have to do it at the same pace, but you don't ever have to get out of it. And so what you find is a lot of people like me love what we do. And I'm like, I don't know if I'll ever really hang up the cleats. I can't imagine the idea of not doing what I'm doing, because it makes me happy.
Yeah. No, I would guess so. I mean, based on, just your path there, and it sounds like you've had the challenges early on and how the industry's changed. I think that's one thing that I think is uh, more recent for a lot of industries, just the interruption, or the opportunity to change, whether it be the technology or just the financing, or the investors, or however it is. It seems like there's been a lot of industries that have gone through change. I was curious. You mentioned the change that happened, and with CBRE or Cushman, you said you're with. They when you started, they were primarily a tenant rep firm. Is that
In
right here
Texas,
in
in
Texas? Okay,
Texas, and they
okay,
were much smaller.
right.
They're probably 6 to 8 times the size now that they were then.
Yeah.
Maybe more than that.
Got it. So is that pretty much, you mentioned like Wall Street, kind of the facilities management
Yeah.
kind of model to, continue to get those recurring revenue streams. Is that pretty much the model now that most of the big commercial real estate brokers are using? Is it more that facilities management so they can have those consistent revenues?
Well, publicly traded, or firms with publicly traded debt, which most of them are at this point in time, they derive over 50% of the revenue on that. As a general rule of thumb, most of the big publicly traded real estate companies derive about 85% of their revenues from working with landlords. It didn't used to be that way 15, 20 years ago, but it's evolved to that, because it is Wall Street driven. And I totally get it. Wall Street doesn't deal with the seasonality that the brokerage business has. I'm in Dallas, and I'm so glad that we're out of the summer, because in August it was almost 108 every single day. And you can imagine how many people were here in Dallas wanting to talk about office or warehouse space when it's 108. They were all in Aspen or somewhere that was much cooler than this part of the country. And so, what you see is an ebb and a flow when you're, I mean, we're a transactional business. We're a service business. We're not doing monthly retainers like you would be if you were selling light harvest systems or, you know, facilities management or just, you know, HVAC management systems, energy management, etc. Even consulting services. So I think it's hard to be publicly traded and talk about that ebb and flow based on seasonality. It's a lot easier to do that when you're when you're privately held.
Got it. And so, Lightbox, you guys started out more on the tenant rep side. Did I understand that you've also kind of migrated into a little bit of the sales leasing? Is that correct?
So we've always done the investment sales side for office and for industrial. In fact, the building that I'm sitting in today, we represented the buyers of this building. The self-storage in the RV parks is an expansion from what we have historically done. So yes and no.
Got it. Well, talking about Dallas, and the metro area for Dallas, from an outsider standpoint, all I hear about is how Dallas and well, Texas and Dallas specifically is just kind of a magnet for business, grow in inbound migration. Is that the case? Are you still seeing that to be the case?
Yeah, 100%. The best way I've heard it described, there's a guy in my office that says the best way to describe our inbound migration is there is a 747 that takes off somewhere in the world and lands at DFW Airport, and all the people get off, but they never leave. And it happens 365 days a year, because that's basically how many people are coming to the Dallas-Fort Worth metropolitan area every single day. So every day you're adding that. And we've seen that from a headquarters standpoint as well. Goldman Sachs is building a headquarters that's supposed to bring 5,000 jobs. Frontier Communications just announced that they're going to be relocating right around the corner in Uptown Dallas for 3,000 jobs. Wells Fargo's building a headquarters that's 3,000 jobs. And those are really big ones, not to mention you have groups that are bringing several hundred jobs like Fisher Investments and so forth. It's not so much those relocations that drive the business. It is, but it's everything that's in and around that. And I go back to 2014. 2014 is when Toyota announced that they were going to be moving to Dallas-Fort Worth from Torrance, California. And at the time, I knew that it was going to be a big deal, but I really didn't understand how much it was going to impact a market, because they announced that they were going to go to Plano, Texas, and they moved there in 2016. And at that point in time, literally, we were still grazing cows and horses on most of the land that's out there. And if you drive out there now, it is as urban as you can get with 20, 30-story buildings and shopping malls and restaurants and density, multifamily living, etc. This is before the Cowboys moved their practice facility out there and all the office space out there. I mean, literally, there just wasn't a whole lot out there. And Toyota built a city. It really is a second downtown in Plano, Frisco. It is there because Toyota made that statement and brought their headquarters there. About 2014, 15, my brother hadn't moved to Houston yet and was leasing a couple buildings. across the street or across the freeway from where Toyota was going in. And I walked through this building that he was leasing, and he said, "Yeah, I'm 95% leased." And I said, "Really? You're 95% leased?" And he said, "Yeah." And I said, "Well, who are these tenants?" And he said, "They're all Toyota vendors." He said, "They're all coming and they're leasing space with 1 to 3 people," because this building had 1,500-foot spaces. That's all they had in this building was 1,500-foot spaces. Kind of a little bit bigger than executive suites, but smaller than what a traditional office space would be. And he said, "They are all moving here because they do work with Toyota and they need to be here close to their headquarters. And then the intent is to grow and take more space once they get a presence." And that's exactly what happened. They came and took those small 12, 1,500-foot spaces, and now they're in 10,000 feet. They're in 20,000 feet. They're in 15,000 feet, what have you, because they've grown and expanded with Toyota. And oh, by the way, there's other vendors that service them, and they moved to the Metroplex to be able to service them. And so it really is this trickle-down effect that you see, and that's what we're going to continue to see on the office side in DFW. In fact, there was an article that came out yesterday that there's 2 metropolitan areas out of the largest 15 metropolitan areas, and there's only 2 that are expected to have positive absorption, and that's Dallas-Fort Worth and Houston. And I think that that's going to be I have no doubt that's going to be the case.
No, that's a quite a kind of a I'm trying to say some sort of the exponent kind of a factor of a large manufacturer moving to your state or to your area. I mean, like you said, I don't remember how many jobs it was you said that Toyota was bringing, but then all
4,000. That was 4,000.
Okay. So I'm just curious, do you have any sense of the number of jobs created beyond the Toyota? I mean, all the support industries that work with Toyota and all. I mean, that to me that's an amazing.
My stats are really stale. They're probably about 7 years old at this point in time, which was right about the time that Toyota had moved in. But at that point in time, you have the Dallas North Tollway that runs north-south, and Toyota is on the west side of the Dallas North Tollway. They're on the south side of Highway 121, and the Dallas Cowboys and there's a lot of other corporate users that are on the north side of 121. Just on the south side of 121, 7 years ago, and you could probably make the case that's double that now. We went from 6,000 to 8,000 jobs on the south side to 25,000 new jobs. So that was 4x, and that's a lot more than just the 4,000 people that came with Toyota. I would say that it might even be greater than that on the north side of 121. You may have seen it go to 30, 40, 50,000 jobs on that side. So I don't have the exact stat for you, but I can tell you that it's just astronomical. And that's my point is, that was 4,000 jobs. Wells Fargo's 3,000 jobs. Goldman's 5,000 jobs. Frontier's another 3,000 jobs. And, the list keeps growing and growing and growing. And that's just on the office side, not to mention the industrial side, which I expect to continue to grow.
Really? So the number that you were talking about, the 4x, you're just talking about office, not the industrial
Those are
side?
office users, has nothing to do. That's irrespective of anything industrial.
Wow.
And to add to that, we did a study and looked at how many office jobs we were anticipating, and this is 2-3 years ago. So the data is more stale now than it ever has been because we've had these announcements of new relocations. But we went and we took a look at all the new jobs that were anticipated to move to the state or to DFW specifically over the next 7 years. And then based on that job creation, we figure that it's typically about 300 square feet per person is the metric that Dallas-Fort Worth uses. Other metropolitan areas could be a little bit denser, but we're about 300 square feet a person. So if you took how many new jobs were coming to Dallas Fort Worth, multiplied it times 300 square feet per person, and then you absorbed all of the vacancy that's out there, because it was 900,000 jobs that were coming here. That was 2.7 million square. No, excuse me. Yeah, 270 million square feet is what the number was that we calculated we would need to be able to accommodate all those jobs. We only have 70 to 80 million square feet that's vacant in DFW right now. And like every other metropolitan area in the country, there's a lot of functionally obsolete product that may have not been functionally obsolete, that is Class B product that no one is going to want to lease. We had some Class C product. So let's just say that we leased all of that. We would still need 200 million square feet to be able to accommodate everybody that was going to be moving here over a 7-year span. Now, let's just say, for sake of argument, that only half of that gets absorbed because of a hybrid work model. Okay, so instead of 270, you're looking at 135. Well, you still are short, call it 70 million square feet. And that's if you absorb all the dogs and cats that you're not going to absorb because, they're functionally obsolete, they're undesirable product, et cetera, et cetera. So the fundamentals long-term are exceptional in this part of the country.
Yeah, I mean that's a definitely a demand curve you'd want to be on if you're in real estate and you've got that many jobs and people needing space. That's a great thing. So speaking of the kind of the supply demand, is it just booming with new construction down there too, or?
We've had the same challenges that everybody else had. 18 months ago, 12 to 18 months ago, the hike in interest rates did not help construction financing. And there's pros and cons to everything, to everything. There's an equal and opposite reaction, right? So you hear people say, well, development is going to stop and die. And that very may well be the case. We haven't seen the new starts that we had seen in the past. There has been a real challenge to get the construction financing to build some of these projects. And these are even projects that are pre-leased even. There was one that was pre-leased, had a bank as an anchor lead tenant, and they couldn't get the financing for it. And we're seeing and hearing more and more stories about that. That's a con, that we can't build that product. The result of that, though, is that when you constrict the construction, when you constrict the supply, and demand is continuing to go up, even if it stayed level, but it's continuing to go up, it is going to increase the values and increase the prices, and the demand's only going to get more and more competitive because we're not going to have that product. If you look at a high-rise office building, it's going to be 3 years to build that, and that's once you get the plans and the permits and you've broken ground on it. So if we're not building anything for 3 years and you see that stop, it's going to correct some of the high vacancies that we've had in the past. Not to mention, the biggest change that we've seen is changes in uses or reuses of buildings. We've seen a lot of vacancy in downtown Dallas go away because it's either been transformed from an office building to a hotel, it's been transformed to apartments or condos, or it's gone to some other type of use. And so that continues to impact and constrict the supply. And I think you're going to see more and more of that in good areas. I think the challenge, I was talking to a buddy in Chicago, and they're the opposite of what DFW is as far as conversions and adaptive reuses. So for me, I said, downtown has so many buildings that they're converting the uses to or doing a mixed use in. And I said, quite frankly, that may be the only Class B product that, from an investor standpoint, I like, because you have the ability to convert it to a different use. Because I'm in Dallas Fort Worth. We have a lot of product that is on the northern edges of the metropolitan area that's 1980s product. So now it's 40 years old. It's brown brick. It's 2-story atrium product, and it's got surface parking, and it's 4 streets off the interstate. Nobody wants to office in that product. And I don't know what you do with that product, because you can't really convert the use. I heard a story about a building like that was under contract, and they said that they were going to turn that into warehouses. There's a lot of pushback from the communities that are saying, well, this is an office building. We have homes right here. We don't want warehouses there. And a lot of the problems on the fringe, that's where we don't have industrial product, because there was so much pushback and you couldn't get the permit, you couldn't get the zoning. It doesn't really make sense to make them multifamily either. So what do you do with this product? I don't know the answer to that. If anybody's listening out there, please let me know what the answer is, and we'll go make a lot of money together. I don't think anybody knows what the answer to that is now. But I say that, I was talking to the buddy of mine in Chicago, and he said, well, downtown is where we're not seeing adaptive reuse. Where we're seeing adaptive reuse is in the Class B suburban product, because that's where everybody wants to be. And so, every market's different. I think the one unifying thing, though, is that there is the workforce has changed. If anybody thinks that we're going back to the way that we had worked in the past, I think that's just a mistake, because we opened Pandora's box. Now you just got to play the hand that you're dealt. And our Class A, Class AA product in Dallas Fort Worth, like most of the cities around the country, doing exceptionally well. 10% vacancy, potentially less. And most of your Class A, Class AA product is staying very well leased. I attribute that to downsizing. There's people that were in 30,000 square feet of Class B space in that same brown brick atrium style surface parking building. And they're like, half my workforce isn't coming into the office. The other half comes in 3 days a week. Instead of leasing 30,000 square feet, let's just go lease 10,000 square feet in the nicest building in DFW. And it'll be better for the people that want to come in. It'll be nicer. We'll enjoy it more. There'll be more amenities, and we'll save money, because we're going from 30,000 feet to 10,000 square feet. So it's a win-win-win all the way around. And we see more and more and more of that. And so, that's why you have the tale of two cities, with the higher end product doing very well, the Class B product, which historically from an ownership standpoint was always considered safe. The reason it was safe was, if you were in a Class C building and the economy did well, then you moved into a Class B. If you're in a Class A building and the economy did poorly, you moved into a Class B. We just don't see that. There's this huge void, huge schism. And I think everybody in the United States is trying to figure out how we accommodate those Class B buildings.
Yeah. No, and you mentioned that kind of a couple blocks off the interstate, 2-story brick with the atrium. I mean, that was pretty much, that was the move back in the 80s, where everybody was going to the suburban, kind of the office park, as opposed to downtown. And funny how the wind blows.
If you think about office buildings, I didn't think that you could get more amenitized than we already had been with buildings, because it started very slowly. we'll put a conference room in the building. We'll put a tenant lounge in the building. We'll put a fitness center in the building. And everybody followed suit. And now you have golf simulators, pickleball courts. The amenitization of these buildings, it blows my mind. Well, you can do that with bigger buildings. You can't do that with a 50,000 square foot Class B building. And that's, from an investor standpoint, that's where I see the biggest schism, as well, as far as there's a bid ask spread between the buyers and the sellers, and that you have a seller who, let's say they have $100 a foot basis in a 50,000 square foot 2-story building. I mean, that's about right. 25,000 foot floor plate, 2 of them. So they're in it for what's that? $25 million, $100 a foot. You're going to get 30% site coverage on one of those buildings. So that's 75,000 square feet. For round numbers, let's just say that it's 100,000 square feet. So we're in it, I guess, for 50 million, right? We're at 100,000 square feet. If you just sold it to the dirt for that, you're looking at $20 a foot. $20 a foot is not sustainable at this point in time for industrial development. And some of these guys are in them for $200, $300, $400 a foot. I'm just picking 100. You have to, there's going to have to be a reconciliation that, the value isn't there. You're really buying the land value, buy it for the land value, scrape the site, and then put something on there. But that's if and only you can get the zoning. So that's why I think everybody's scratching their head saying, what is this going to look like? How is this going to shake out? What's going to happen when these loans come due? Because there's 2 things, really 3 things going against them. Number one, the taste has changed. Number 2, the interest rates aren't helping them out. And number 3 is kind of in line with number 1, but the workforce has changed. So I don't know what you do.
Yeah, I think that what you're saying is what I'm hearing, everywhere else. And I know when I drive around Portland, Oregon, you see a lot of the office buildings, 1st story, 2nd story, are empty. And if you go in one, it's like you can walk a long ways before you can see somebody. It's kind of weird.
But it's relative. It's different product type and it's different markets, because it's also sub-market specific as well.
Yeah, absolutely. I know, when I say Portland, there's a lot of pain in the downtown, but the outer burbs are doing pretty well.
Mm-hmm.
And there's been that migration. I think it's like you said, it's kind of the workforce has changed, where people want to be has changed, the product, and also the space demand. The requirements they need for the space, like you said, if they had 30, now they're moving down to 10. They got a nicer space. People come in a couple times a week as opposed to 5 days a week. And it is just kind of a change. And I don't know that it's all for the better. It's just different.
It's different. It's too early to tell if it's better or worse.
Right. No, and there's definitely some convenience factors. I mean, certainly the commute from the bedroom to the office is a lot shorter and easier than getting in the traffic with everybody else, kind of thing. But the community and the sharing of ideas and just the being around people and I think there's some work that it's hard to measure when you're in the space together. And I'm just curious how long it takes before people recognize that there's more of a benefit there than not. And, kind of see that grow back. And maybe you won't, maybe it'll be all this kind of Zoom talk and stuff, but I would think that just some sort of a, well, I don't know. It'll be interesting to see what it evolves into, and we'll be there when we get there, I guess.
Well, we're hearing from our clients even from our own experience, that the biggest challenge is training. For workforce that doesn't require training, the virtual office works exceptionally well. It's really hard to train virtually, because to a certain extent, training is a contact sport, and you really got to be, there's just so much more to be absorbed that's just harder to pick up virtually. And so I think that's probably the biggest unknown out there is what does it look like? What does it look for the next generation that's coming up that because what do you learn in school that you apply in your job? Very little. And I say that as somebody who has a degree in real estate, very little. This job and most jobs, we always laugh and say that we're a blue collar, white collar job, but I think most jobs are, and that it's on the job training. You learn as you go. You make a lot of mistakes. You just try and make fewer mistakes than the guy next to you. And it's hard to do that in a virtual environment. And so I'm very keen to see how that plays out long term as you continue to have new people enter the workforce.
Yeah, no, definitely there will be, I would say probably a decade or two out, we can look back and kind of, tell more of the story. But right now it is kind of an interesting time, and we will see where it goes. Hey, Grant, if we could, I'd like to shift gears here for a second.
Sure.
By day, I'm an insurance broker. And as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk. When that's not an option, we look to see if there's a way we can minimize the risk. And if we cannot avoid nor minimize the risk, we look to see if we could transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. It could be your clients, investors, interest rates, development, demand, however you'd like to identify and what you consider to be the biggest risk. And again, for clarification, while I'm an insurance broker, I'm not necessarily looking for an insurance-related answer. And so if you're willing, I'd like to ask you, Grant Pruitt, what is the biggest risk?
Sure, I'll give you the micro first, and I'll give you the macro. So from a micro standpoint, with primarily offices in the state of Texas, the biggest risk is the perceived safety of the cities. As long as the cities in the state of Texas are perceived as relatively safe, we'll continue to see that inbound migration. The schools have always been an issue, and people always talk about schools, but the minute people don't feel safe, that's when you see a flight to other parts of the country where they do perceive that safety. That's the micro. From the macro standpoint, it's probably going to be the same concern tomorrow and next year, 10 years from now, 20 years from now. It's always the lending facilities for me, because I'm in commercial real estate, and I always quiz people and say, who owns all the real estate in the United States? Because the United States is different than some other parts of Europe and so forth. The banks own the real estate because they have loans on most of the real estate that's out there. And when we have hiccups in the lending facilities, that's where we have real trouble. We saw it in, the 1980s, 2008. Anytime that banks fail, anytime we see issues with lending, potentially alternative vehicles that create more risk, that is a huge concern.
Yeah, no doubt. The lenders and just the effect that a rate change has on the market is it's kind of scary when everything's going one direction and all of a sudden rate changes and I'm kind of curious, because in just my experience, and I'll be curious to hear from you what you think. It's that interim between the rate we were at to the rate we're going to, that's the challenge. But once we get to a stability or a stable rate and people can have figured out how to do business in that rate environment, then things get back on track. Do you see it that way, or do you feel like it's just it works at this rate, it doesn't work at the other rate?
I think that we got really used to having essentially extremely low interest rates on historical basis for a long period of time. And we forgot that interest rates weren't always at that level. I mean, even not that long ago, they're well above that now, but I think about the first house that I bought, and I was pretty pleased. I got a 5% mortgage rate. And when 5%, when we went from people being, 3s to 5, people all of a sudden went, oh my gosh, I don't know how we'd ever be able to buy a home. You got to play the hand that you're dealt. And I think poker's probably the best way to look at it, because, all right, they deal you 5 cards. You're not married to those 5 cards. You can trade them in for different cards, and if you don't like it, fold that hand and go to the next hand, but you just got to keep playing the hand that you're dealt. And I think that when Warren Buffett he's got some great one-liners, but he always talks about when they zig, you zag, and everybody is looking one way, and I know he's going to do the opposite. He's the one that he bought some of the banks that failed in 2008, and they asked why he did that, and they ended up being incredibly lucrative endeavors for him. I'm not a huge believer that you blame it on the interest rates, you blame it on the instability. There's always something to blame. I think you just got to play the hand that you're dealt, and you got to be smart, and you got to put the pencil to the paper and trust what the numbers give you, and make your decisions based on data, not based on the noise that people talk about. Because I'll be the first one to tell you, I get people that tell me, oh, well, I read this about real estate and I read that about real estate, and they've been doing that my entire career, and they make what I feel are, even this morning, very poor real estate decisions based on what they read in the newspaper. And I don't see that, because I don't pay attention to that. That's somebody who's got an opinion, and I'm looking at the data. I'm looking at the information that's available to us and trying to make informed decisions. And that's part of my passion in life, is to help tenants make decisions based on that data. So yeah, I would agree with you, but I'd also challenge that at the same time.
Yeah, no, I think your summation there, you got to deal with the hand that's dealt, and also make sure the numbers work. Makes sense. Hey, Grant, where can the listeners go if they'd like to learn more or connect with you?
You can go to whiteboxrealestate.com, or you can shoot us an email at contact@whiteboxrealestate.com.
Awesome. Grant Pruitt, I can't say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Absolutely. Thank you for having me.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.